Good evening, Rick. This is the Anderson Report. We're on maybe half a minute early. My name is Tim Anderson. This is my YouTube channel, The Anderson Report. I also simulcast to Periscope at TJ Anderson 12. Today is Tuesday, February 2nd, Groundhog Day. We are at the tail end of a major snowstorm in the East Coast of the United States, probably about 18 inches of snow just outside of New York City. And from what I've seen, close to that much in the city also, much more in outlying areas. And wherever it is in Pennsylvania that the groundhog makes his appearance, I understand he did not see his shadow today. And what does that mean? Another 6 weeks of winter? Is that what that means? I'm not completely up on that. I think that means another 6 weeks of winter. So we've had a very light winter this season so far. One snowstorm maybe a month ago. But it came in full force starting Sunday afternoon, early evening. And it's not going to warm up right away, so it's going to be around for a while. John, it's great to have you with us tonight. Once again, we signed down a touch early. This is the Anderson Report. Another very active day in the stock market. The major market averages pretty much did a repeat performance of the strong rally they put in on Monday. And the heavily shorted, let's call them meme stocks that have been the focus of attention from the Reddit rebels and the Reddit Wall Street Bets chat site. And a few other avenues of social media, they were down heavily again today for the second day in a row. And we are going to do a little bit of a recap of the market action, where we stand now versus where we were maybe a week and a half ago. And then we'll continue our deep dive into what's going on with all the crazy action in these, what had been, and to some extent might still be heavily shorted stocks, the Reddit chat room, the Robinhood scenario, what it means, what it doesn't mean, and what investors should be thinking about going forward. So, look, the Dow Jones Industrial Average gained 475 points today. That's a gain of 1.5%. It closed at 30,687. It was flirting with the 30,000 level early Monday and last Friday. That's a gain of what? About 2.25% for the last 2 days, very close to eliminating its decline of 2.5% from all of last week. Usually they say when stocks go down, they go down faster than they go up. That has not been the case the last couple of days. The S&P 500 gained a little over 50 points, a gain of 1.4%. It's been up 3% over the last 2 days. Last week, it declined 2.5%. So it has wiped out the losses from the S&P 500 has wiped out the losses from last week. The financials were pretty strong today. The energy sector was reasonably strong. I saw oil trading up above $54 a barrel. And the S&P 500 at 3826 got through that area that we thought would be significant resistance if yesterday's rally were to continue. That was the 3780 to 3800 level. We got through that pretty easily today. The S&P closed at 3826, the all-time high, the all-time closing high for the S&P from a week ago Monday, January 25th, is 3855. So that's another 30 points, 29 points to be exact, on the way up, maybe about 0.75% away from that. You got to, if we continue to rally tomorrow, you got to watch the 3855 level on the S&P 500. That's the all-time high. I would expect to see some resistance at that level. Excuse me. It's been a long day, a lot of phone conversations. I'm a little parched, but thankfully I have plenty of water here. I'm not going to lose my voice in the middle of the broadcast. Now, the NASDAQ composite up 209 points today. It gained 1.5% after a 2.5% gain yesterday. It closed at 13,612, a little bit more than that, almost 13,613. Like the S&P, that's pretty close to its all-time closing high, which was also on January 25th, a week ago Monday, and that all-time closing high was 13,636. That's 24 points, 25 points away from an all-time high on the NASDAQ composite, probably even probably even closer to that level in percentage terms on the S&P 500. You could be there in a blink of an eye tomorrow. We had earnings from Amazon and Google, two top 10 components of the NASDAQ composite after the close tonight. We'll get into that just a little bit later. The Russell 2000 had a nice day today, up 25 points. It closed that's 1.2%. It's had a little bit less of a gain, although the Russell over the last 3 or 4 months has just vastly outperformed the other indexes after trailing them for a couple of years. The Russell closed at 2151.50. The all-time closing high for the Russell, 21,686. That's a move of about another little bit less than 20 points. 21,686. That's to watch on the Russell if it continues to rally. The breadth of the market was very similar to what we saw yesterday, pretty strong. Little bit better than 2-to-1 on the advanced decline line at the NYSE. 2,450 stocks advanced, 750 declined. That's a little bit better than 3-to-1. NASDAQ, almost 3-to-1. We had 2,900 advancers, 1,000 decliners. It's been a broad rally the last 2 days. And frankly, a lot of it has been fueled by the fact that the stocks that are the so-called meme stocks, or the stocks that the chat rooms in Reddit and this now infamous Wall Street Bets chat room, which had maybe 1,700 followers or users a month ago and now has about 7,000 or 8,000. These are the stocks that a lot of people in that chat room have been pushing. Buy these stocks. There's huge short interest. We can create a short squeeze and really hurt these hedge funds, et cetera, et cetera. They had a lot of fun with it for about a week and a half. It sure seems like that party is, if it's not over, it's winding down pretty quickly. So, what happened with those stocks today? Well, GameStop, which is pretty much the poster boy stock for the whole short squeeze and the entourage of the Reddit rebels, or whatever you want to call them, promoting the idea that we're going to buy all these these stocks that have very heavy short sales. And sure, GameStop went from, it was $30 maybe 4 or 5 weeks ago. It shot up to 60, then it shot up to over 100. It got up to about, for a couple of days last week, it was around the 325, 350 level, even flirted with that level Monday morning. And then it's been down sharply. GameStop declined $135 today. GameStop closed at $90 today, down $135 from the close on Monday. And Monday it was down $100 from the close on Friday. So in 2 days, GameStop has gone from $335 to $90. That's a decline of, let's see, 180, 270. That's a decline of close to 70%. A couple of other notable names that have been hit hard that were extremely, had extremely sharp rallies. AMC is maybe the number 2 stock on the list of stocks that the Reddit rebels were promoting everyone to buy. AMC closed today at $7. That's the movie theater chain, at $7.85, down $5.50. Closed yesterday at $13.50. At one point at the end of last week, it was at $20. So it's down well over 50% since late last week. KOSS, KOSS, is the headphone company. It's a little bit interesting and ironic to me that a lot of the Reddit rebels in the Wall Street Bets chat room were promoting to buy a stock of KOSS, which is pretty much outdated technology. At one point in time, a few decades ago, before Beats and a few of these other new age headphones came out, KOSS was the state-of-the-art higher-end headphone that you bought if you had a Sony Walkman or a Sony Discman and you wanted to upgrade the speakers that came with those units. And you bought KOSS headphones. And it's interesting to me that the people that were all pumping that stock as a stock to buy probably have never heard of KOSS headphones, would never own a pair, because the world today is all earbuds, pretty much. But that stock closed today at $20. It was down $15. I think it might have traded between 45 and 50 at one point last week. Another stock that's down well over 50% from its peak. Bed Bath & Beyond. Many people know what that store is. Closed at $25 today, down $5, but down from $53 on January 27th. That's over a 50% decline. The only other one worth mentioning is BlackBerry. The symbol is BB. It closed at $11.50, down $3, a mild decline compared on a percentage basis compared to a couple of others. But last Wednesday, it closed at a little over $25, so it's down also well over 50%. Now, some of this is a little bit repetitive from what we've talked about the last couple of nights, but I've gotten a number of questions, a few phone calls, a few text messages from people. And I know that, and I certainly appreciate that there are a lot of people in watching my videos in my YouTube channel. And once again, this is the Anderson Report. This is my YouTube channel. If you are new, a relatively new watcher, please subscribe to the channel and you will get updates of when the next broadcast is going to be. Typically, I like to do them at about 7 o'clock. I hadn't been on for a while, so Wednesdays went a little bit more than an hour. I try to keep it to 45 minutes. I started a little bit early yesterday because I thought it would probably go just over an hour. Today we started at 7 o'clock. That's the time that I think works really well. It gives me enough time after the market close to collect a few meaningful thoughts, get some data put together, and run through the day. And then hopefully people that I realize a lot of people are working from home, but maybe you've had a chance to get a bite to eat. Maybe people that commuted are home. And 7 o'clock seems like a good time, but I'm interested in feedback of how that works for people. So if you're a new watcher, subscribe to the Anderson Report on YouTube. You'll get notifications of when the next broadcast is going to be. I try to schedule them at least 2 hours in advance, sometimes even more in advance than that. It also gets simulcast to Periscope at TJ Anderson 12. They are both great services. I think that the YouTube broadcast tends to be a little bit cleaner. Yes. Can you explain to your audience naked short selling? John, I am definitely going to get into that. That's one of the topics that people have said that it might be a good idea to explain both short selling and naked short selling, because technically there is a difference. And so, since we're talking about short selling, and since we're talking about all of these people from this Reddit channel, Wall Street Bets, which has gotten just so much attention over the last period of time. You've had numerous people that have something to do with that channel on a couple of the business networks, talking about how this all started and what their view of it is. I'm sure they've been, and I know also that someone was on the Yahoo Finance feed. Yahoo Finance is like a CNBC/Fox Business version of financial news that is basically online, and they do a pretty good job. So they've had people from Reddit, they've had people from the Wall Street Bets chat room, they've had people from Robinhood on the air occasionally over the last few days. And so what is short selling? Short selling means that you are basically making a bet that the stock or whatever you are short selling is going to go down. Obviously, if you buy a stock, you're making a bet that the stock is going to go up, or you're investing in a stock because you believe that the aggregate returns from that stock, both the dividend, if they pay one, and the capital gains, meaning maybe you buy a stock at 45 and over a couple of years it goes to 60. That would be a 15% gain on a $45 investment. So that would be, it would be maybe an annualized gain over 2 years of maybe 15%. Okay. So if a stock went from 45, if a stock went from 45 to 60, that's a 15% gain overall. That's a $15 gain, but on a $45 investment, it's a 30% gain. So over 2 years, that would be an annualized gain of 30%. And if they also paid a dividend of 4 or 5%, that would add to your gain. That would be a very attractive scenario to be involved in. Clearly, not all stocks have that performance. It's never a straight line up. And some stocks that have very high, that have a very high dividend yield, you have to be a little bit careful because some of those dividends might be at risk of being cut. So if you are short a stock, which is the opposite of being long a stock or investing in a stock, but if you are short a stock, you are betting that that stock is going to go down. Well, what really happens? You're selling a stock that you do not own. Well, how can that happen? Okay. Well, let's say, let's pick a stock that is very, very, very widely owned by a lot of people. And let's just say it's XYZ Corp. And XYZ is a big household name, and it is owned by many institutions. It's a top 100 name in the S&P 500. It's got 1 billion shares outstanding. A lot of retail owns the stock. A lot of institution owns the stock. And a lot of people own this in what they call street name, which almost everyone owns their stocks today in street name. You don't have physical certificates. So every firm out there, Merrill Lynch and Smith Barney and Charles Schwab and A.G. Edwards and Fidelity Brokerage and all of the brokerage places that have big retail and also do institutional business, they're going to have that stock in-house on deposit from their customers that own that stock. So if you're a individual or a hedge fund and you want to short a stock, your clearing firm or your prime broker, if you're a hedge funds have prime brokers, which basically means all of their trades kind of get centralized and coordinated through one firm. So that even though they may be trading with a lot of different firms, all their positions get centralized at one place. That just makes it so much easier for them to reconcile what their positions are every day. So if you're going to short a stock, your broker has to be convinced that he can borrow the stock. Now, if they've got the stock in-house on deposit from retail or institutions, and it's a widely held stock, it's not going to be an issue. Your person at that firm is going to say, oh yeah, sure, you can short XYZ. It's a big name. Okay. So now, if a lot of people start to short a stock, let's say there's another stock that's just not that widely held, they might have to go to their stock loan department and they might have to say, look, we've got a customer here that wants to short 25,000 shares of XYZ. Okay. We don't have the stock in-house. Can we borrow it? And that means, is it available in the street? The stock loan might call, they would call around to a couple different firms and say, we need to borrow some XYZ. Oh yeah, we've got that. But there's always, there's an interest charge on it. Oh yeah, that's not a problem. Okay. Now, once a stock gets difficult to borrow, let's say there's a lot of firms that have shorted XYZ. And XYZ is a stock that's shorted by a lot of different hedge funds or customers. Okay. And then if another fund says, we'd like to short some XYZ, and if it might come up on a list that shows difficult to borrow, because there's a list that gets circulated. Okay. If a stock meets certain characteristics, it's on a list of difficult to borrow stocks. And in that case, you've got to call up your broker and say, your person in your back office is going to have to be confident that they can borrow the stock. So they might call one or two places and say, somebody might tell them, oh yeah, we do have some of that. You can borrow it. Okay, fine. So now, in the case of GameStop, a number of different things could happen. It was widely reported that 140% of the outstanding shares was short. I really don't believe that number. I think what they really meant was that 140% of the outstanding the float was short. Okay. Because if let's say that your back office tells you can borrow the stock, and that person at your account says, "Oh yeah, you can borrow the stock," but then they can't borrow the stock, and then it comes to delivery date, and the trade has not settled. So then there's something called a buy-in, where if a firm doesn't get the stock delivered to them that you sold after a week after this trade is supposed to settle, these aren't the exact time frames, but I'm just creating a scenario. If a week goes by and you sold 10,000 shares of XYZ and that stock has still not been delivered, they might just issue what they call a buy-in, which means they're going to go into the open market and they're going to buy that stock because they have to have it in-house because you sold it to them and the trade has still not settled. And they're going to go in and buy that stock in the open market. Okay. That becomes a very crazy situation. And we definitely saw very crazy situations in GameStop, in a lot of the other stocks, and so forth. So obviously the question is, how can these news reports be that there was 140% short of the outstanding shares? Well, if it was really the case, then a lot of the people at the clearing firms and at the prime brokerage firms weren't really doing their job in saying, you know what, you got to put out memos to people. Nobody can short GameStop. Nobody can short this stock anymore. It's too hard to borrow. We've already got fails on it to deliver. We've got to go into the open market to buy it out. It's going to get ugly. And don't let anybody borrow the stock. So either that didn't happen, or the other thing that could have happened was there were very large amounts of options trading in GameStop. Okay. Now, a lot of these traders that were trying to create a short squeeze in the stock to get some personal satisfaction out of hurting the hedge funds, okay, that were short the stock, went into the options market and they bought calls on the stock. In the options market, if you buy a call, that gives you an option to buy the stock at a certain price. And there are different prices that you can buy you can buy an option to buy. Look, when GameStop was $5, $7, $8, $9, there was probably an option to buy the stock at $10. There was an option to buy the stock at $15. There was an option to buy the stock at $20. Okay. So, excuse me 1 minute. If you go into the options market and you buy lots, and you and a collection of other people that are all trying to do the same thing, create this short squeeze in GameStop, and they were very astute because they could see that there was a very high short interest in GameStop. So they thought if we could get thousands of people, okay, and when I gave those numbers earlier for the number of people in the Reddit chat room, it should have been millions, not thousands. They had about 1.7 million members watching in the Wall Street Bets chat site, subscribe to it. Doesn't mean they're all watching it every single day. Okay. Like I'm sure there's people that are subscribed to my YouTube channel that don't necessarily watch every episode. But you can go into Wall Street Bets, and I have never been on Reddit, just in full disclosure. But you could go in there and you can look at that chat room and you can sign up for it so that you can then get notifications maybe as to when certain things are mentioned in it. Okay. So you go in there. If 1 million people all went to buy 100 shares of stock, that would be 100 million shares. Okay. if a lot of people went to buy options, and let's say there were thousands and thousands and thousands of call options, okay, traded, who's going to sell those to you? Well, the market maker at the CBOE in Chicago is going to sell those to you, okay? And there are certain market makers in the options market that certain people will be an option market maker in GameStop. Certain people will be an option and a market maker in Best Buy. Certain people will be an option maker, a market maker in General Motors options. All the stocks that have options listed on them will have a different people or different group will be the market maker in those different options. So if thousands, tens of thousands of options trade, one option is worth 100 shares. So if tens of thousands of options trade in GameStop and the market maker sells them to you times 100, that's how many shares he is potentially short. Now, he didn't have to go to his stock loan department, okay? To ask to borrow the stock, because he's not borrowing the stock. He's just selling you the options. But what the option market maker firms will do is they always want to keep their positions neutral, okay? So once they are short a lot of options, a lot of call options, they either have to then start buying the call options, but if every order that's hitting them is a buy and not a sell, they then have to go into the stock market and buy the stock to hedge that position. Okay? So if they're short 25,000 shares, if they're short 25,000 options, they might have to buy, and all of a sudden those options go in the money, which meaning they're short the options to buy the stock at $10, and now the stock's trading at 12 or 13. If they're short 25,000 options, that means they're potentially short 250,000 shares of stock. Okay? And they're just short that stock without going to without borrowing it. So, and without even asking if they can borrow it. So some of that overage on how much was short of the total outstanding could have come from the options market. But some of it also just could have been a little bit of a misinterpretation. And I think there's been a tremendous amount of misinformation on a lot of things related to everything that's gone on in the last week. They could have been talking about 140% of the float. Now, the difference, if you look up in Bloomberg, and I'm sure most people don't have a Bloomberg, but if you look up in Yahoo Finance, or if you look up in Google Finance, or if you look up in some other mode of looking up a company's financials and statistics on their capital structure, it might mention the number of shares issued and outstanding. It might mention the float. And if it doesn't say the float, it might mention freely tradable stock. Because if a lot of insiders, like the CEO, the chairman, other big senior executives, and even some venture capital firms might have stock in that company that's not freely tradable. Okay? There might be 120 million shares issued and outstanding, but only 80 million shares freely tradable. The freely tradable stock is the float. The difference is stock that can't be sold without someone filing an SEC report because they're a corporate insider, a control person, or maybe they have a 2-year lockup or a 1-year lockup if they're a venture capital firm that invested in private stock at some point in time. It gets a little technical. I'm trying to make it as simple as I possibly can. I know there's a lot of people watching that have different levels of knowledge. But that's kind of short selling, is selling something that you don't own because you think the stock is overpriced. And if it's trading at 80, you really don't, you think, just as an example, you might think that it's crazy for this stock to trade at 80. Every other stock in its sector is trading. It's crazy for this stock to be trading with a 40 PE multiple when every other stock in the sector is trading with a 20 PE multiple. And it's not that this company has something going on that's so much greater or so much more spectacular than every other company. Now, there's times when companies do get like exaggerated valuations. And most professional short sellers do not short stocks just on exaggerated valuations. Most of them short stocks because they feel that there's something wrong with the company and that their business prospects are either being wildly over exaggerated or that they are going to have some tumultuous issue going forward. Okay. There are people that will short stocks based on valuation, and some of them might be long short funds. There's a lot of long short funds out there that are not necessarily hedge funds the way most people talk about hedge funds, but they're just a fund that's running a balanced book, and it's probably even in their charter that they are going to be a long short fund and never be more than never vary from being either 60% long, 40% short, or being more than 60% short and 40% long. And what long short funds do is they try to buy quality stocks, okay, and then they will short a similar amount of stocks that they feel are a much lower quality, so that if that whole sector or industry gets hit and takes a downturn, the lower quality stocks will go down more than the higher quality stocks. Or if that sector has a big rally for whatever reason, let's say it's in the energy sector, and oil goes from 30 to 80, okay? A long short fund will be long stocks that it feels will do better in a bull market than the stocks that it's short, and it'll be long stocks that they feel will not go down as much in a bear market as stocks that they're short, okay? And there's plenty of those. Maybe not mutual funds, but plenty of hedge fund, but plenty of funds that are not necessarily hedge funds, privately managed funds, and they may, some of them specialize in certain sectors, and some of them are multi-sector or market-wide. So short selling is something that is not necessarily evil. It's not necessarily destructive for the market. It actually helps the market become a lot more efficient. It adds a lot of liquidity to the market, and it really helps define relative value in the market, and specifically within individual sectors. Betting against themselves. Well, Hisburn, yeah. See, the banks had this issue in 2008 too. They were betting against themselves, but they were also under attack from a lot of people that just kept shorting them and shorting them and shorting them and doing some things. There was a lot of funny stuff going on, and at one point in time, even I believe the SEC mandated that you could not short financial stocks because the financial system was at so much risk. Okay. You explain. So naked short selling, John. Naked short selling goes on a lot with very, very low price stocks. And naked short selling, I don't know is truly people selling the stock that have not borrowed it. And there are glitches in the system where some people have figured out how to do this. It shouldn't be allowed. It's frankly illegal. It's a violation of SEC rules to knowingly short stock that you have not borrowed and don't plan on borrowing is illegal. It's a violation of SEC rules, and it's something that the regulators need to spend some effort on tightening down how that is monitored more extensively. Shorting stock that you know you cannot borrow and you don't plan on borrowing is a violation of SEC rules. It's illegal, beyond being just a violation of SEC rules, and it should not happen. But certain nefarious players in the market have found ways around it, and it is a thing. Now, some people might refer to naked short selling as naked short selling in the option market would be shorting calls and not owning the stock. Okay. Or you could be naked short puts, which would have a little bit less risk. If a stock was, if you had a lot of capital in a margin account and a stock was 50 down from 100 and you thought there's no way this stock is going any lower, you might sell the 45 puts for $5, saying it would have to go to 40 and I'd still break even. And if it did go below 45, you could get put the stock. So you would have to have the money to buy the stock, but you're betting that it's not going to go down that much more. And B, if it does, I'd be very happy to own the stock at 45, because if you sold the 45 puts for $5 and you ended up having the stock get put to you, your cost would really be $40 because you got $5 income from selling the 45 puts for $5. You bought the stock technically at 45, but your cost is really only 40. And if it's something that's down to 50 from 100, and you think you know the company and you're very comfortable with owning it lower, that's when really smart people on occasion do sell naked puts. Selling naked calls, look, the stock could go to, it could go from, GameStop could have gone from 300 to 600 to 800. You just didn't know. It was crazy. It's 7:42. Are naked shorts advantageous in high frequency trading? Well, John, it's a very, very, very technical topic. The high frequency traders have positions that really last for seconds. Okay. So high frequency traders, they're buying order flow from big retail operations, and they're trading against that order flow. And then as soon as they have a position, they're covering it. Okay. So if the spread on a stock, and a lot of times you might see stocks trade in less than a penny. So let's say a spread in a stock is one. I'll make it a high price stock just to make the example a little bit more clear. 134 to 137. Okay. And you're a high frequency trading firm and you just bought some order flow and they want to sell 200 shares of XYZ at 134 on the bid. You buy it from them. You're long the stock. You're going to turn around right away and try to sell it a penny above where you just bought it. And they do this constantly all day long. Tens of millions of shares of stock. Okay. I don't really like that business. I think it's a little bit destructive for the market. And the reason that all these retail firms. Now, the reason that Robinhood and Charles Schwab and all these other online retail firms are now letting you trade for free is because they're selling all that order flow to high frequency trading firms that are trading against it. Okay. So a lot of times, if maybe you could get an execution at 135, but you're getting an execution at 134, that's because your order flow is being sold to a high frequency trading firm that's buying those orders on the bid or maybe just below the bid. Okay. And then they're selling out almost instantaneously as fast as they can. Even if it's only to make a tenth of a penny or a penny, they will, as fast as they possibly can, eliminate that position and go home at the end of the day with as few positions as possible. Okay. And I know that sounds crazy, but they're trading tens of millions of shares of stock. If they could make a tenth of a penny on every one, they'd be absolutely thrilled. Okay. So I just don't think that the short interest numbers, because they're reported to the SEC would publish them twice a month. There are services out there that say they can update them every day. I question how accurate they are since trades settle T+2. So if you do a trade on Wednesday and this firm that's people have quoted on TV numerous times says that, well, our algorithm tells us that now the short interest has declined by 5 million shares. Well, guess what? The trades that happened on Wednesday aren't even going to settle until Friday. That's T+2. So I don't know. You know, they say they have an algorithm that estimates how much was sold short. I don't know where they get the data from. Okay. I'm sure they've got, I'm sure they can make a best guess, but this is a crazy situation. All right. And I question whether they're, how accurate their data is and how up to date they can really tell you what the short interest now is, since the trade's not going to settle for 2 days and there might be some fails involved. Even though it's T+2 in a crazy stock like GameStop, I bet a lot of those trades are settling T+3, T+4, T+5 before an actual buy-in would happen. Okay, because a lot of times a back office of a firm will go to a firm that they traded with and say, look, you did these trades with us yet 2 days ago. They haven't settled yet. We haven't seen the stock. So they'll give them a couple of days at least before they would potentially buy them in. And as crazy as GameStop and AMC and a lot of these other stocks have been, where settlement is T+2, a lot of these stocks, and I've talked to a couple people in that part of the business, a lot of these trades with these stocks are settling T+3, T+4. Okay? That makes the validity of these short interest numbers even more questionable. And the fact that there's been a lot of these trades have settled a day or 2 or 3 beyond T+2, that's one of the reasons that the clearinghouses wanted Robinhood to put up so much extra dough, because there's always a risk that something really fails. Okay? And the clearinghouses don't want to be caught holding the bag. So for them to tell Robinhood that they got to put up an extra $3 billion, and Robinhood got that down to a little bit less than $1 billion, because they said, look, here's what we'll do. We'll restrict the trading in these stocks to very small amounts. First, they restricted it completely to new positions, although you could always sell your existing position. Then they said, we'll restrict it to very small amounts. And then the clearinghouses said, okay, you don't have to put up $3 billion. You can put up $700 million. But we need more dough on deposit. Okay? And that's why Robinhood went out and raised so much money, because their volumes were exploding. They could have been processing hundreds of billions of dollars worth of orders a day. And the clearinghouse is like, you got you got to have more money on deposit here. So all these wild conspiracy theories about Robinhood, being in cahoots with the hedge funds and all this stuff is totally ridiculous. It's totally ridiculous. And I'm not a big fan of Robinhood. I've said that before. I don't really care for their business model. But I they did the right thing the last 3 or 4 days. All right, look, we're coming up to 7:50. I really appreciate the questions. I like having the people in the chat. I try to address as many of them as I possibly can. You can always get me on Twitter, TJ Anderson 1. It's not like I'm like glued to it every minute of every day. I do post stuff on there on the market on occasion. I definitely watch it a number of times a day, sometimes more frequently than others. This is my YouTube channel, The Anderson Report. I also simulcast. Please subscribe if you haven't subscribed yet. Please hit the little like button. I also simulcast on Periscope, TJ Anderson 12. And you can get me on TJ Anderson 1 if you have questions about anything. I do try to respond to them. I'm going to try to do another broadcast tomorrow at 7 o'clock. But there's a lot of stuff going on here, not just the weather, a couple of other things I've got to deal with the next couple of days. Look for the updates on when the next broadcast will be. I appreciate all of the viewers, and hopefully we'll keep this going. Thank you very much. Enjoy the rest of your evening.